Gautam, good to have you back. Thank you for joining us. What's your assessment of the earnings season so far? We're off to one okay number, one bad number, and one terrible number, Infosys.
Yeah, hi Nikunj. Good afternoon. Thanks for having me. I think earnings season hasn't yet begun actually. Just we've seen three or four numbers, out of which IT has been muted set of numbers, both from TCS and Infosys. HDFC Bank, as always, has delivered the 20% growth. I think this weekend you will see some fireworks now with Reliance and ICICI Bank reporting. And this is, I think, a pretty extended earnings season, given that this is the last quarter of the year. But we are expecting the big trends to remain same, Nikunj, as per as the broader corporate earnings are concerned, which is that growth will look decent at the aggregate, but it will be led by few sectors and very few stocks. I mean, we are expecting about 14-15% corporate earnings growth for Nifty and our broader coverage universe. But 90% of the incremental growth is led by financials and auto, within which financials is 70%. So financials has been doing the heavy lifting for last 2.5 years now. In fact, for the full year also, if I look at my Nifty estimates, we are talking about a 12% earnings growth for FY23. Without financials, that drops to just about 3%. So that's been the kind of the story for the entire year. But if I have to paint a bullish picture, I look at the entire earnings without commodities, the growth is 30%. So it depends on which side of the coin you are on, and then you look at the numbers. But the skewness, narrowness of sectors and stocks which are contributing to earnings is a phenomenon from last 3-4 quarters. In fact, in Nifty also this quarter, just 5 stocks are driving 82% of the incremental growth of 14% that we are estimating for the quarter. Right. So consumer and IT are expected to be very tepid, 10% kind of a growth. Pharma is making some sort of a comeback, but just about 9 to 10% growth. And that 9% itself is a 6-quarter high as far as our pharma coverage universe is concerned. So that basically tells you how bad the previous 5 quarters were. And then on the downside, you have the same old commodities, metals, cement dragging it down.
You touched upon pharma, but separately, I also wanted your take, Gautam, about the real estate pack, because I was going through some of your reports and you are anticipating quite a decent upside on some of these names, 50 to 58% kind of upside on the likes of Sobha, Prestige Estates, quite positive on Godrej as well as, Prestige Estates and Lodha as well. What's the thesis and what are the top recommendations?
Yeah, so the top recommendation is Godrej and Lodha, out of which Godrej we have added in the model portfolio. Thankfully, before the run-up happened, we also changed our rating there to buy. So the whole view on real estate is a bit positive because of the pause in the interest rate hike cycle. Second, their own announcements, if you go stock by stock on project developments, pre-sales, they seem to be in a bit of a strong momentum right now. We are expecting a significant improvement in profitability for Godrej Properties going into FY24. And stock had corrected a whole lot, year and a half back when we had initiated coverage, the same name was around 900 rupees. So relative risk reward is what compelled us to replace Lodha with Godrej. But our view on real estate is constructive. However, one needs to be cognizant of the overall allocation that one can have towards this sector in our overall portfolio, because this is a non-benchmark sector. There is a zero weight of real estate in Nifty and Sensex. So to that extent, how much allocation can you do in an overall portfolio is what is going to decide the implications for your portfolio returns. But bottoms up, we are positive on real estate.
Gautam, just alluding to what you were previously stating, you don't seem quite convinced about, the buying that one is seeing off late in pharmaceuticals. Why is that?
No, in fact, Aisha, we moved from underweight to neutral on healthcare in January. Right now, we are keeping it neutral as far as the model portfolio weight for that sector is concerned. The reason I'm not completely convinced is because of the unprecedented volatility that you've seen in a so-called defensive sector, because the earnings predictability has been virtually absent in this sector. If you look at the last 5-6 quarters, they've been very tepid, minus or plus or minus 2-5%. So one quarter, which is looking good right now, it's looking good on a relative basis. What essentially you are seeing in portfolios is banks, everyone is well, positioned. It's kind of an overowned sector. IT, after the recent hauler from Infosys, incremental capital allocation towards that in the portfolio will be very limited. So if you have to rotate the sector, then pharma becomes one of the choice, and of course consumer, because auto also, if you look at the positioning of the top 20 mutual funds, when I looked at our fundfolio report that we published yesterday, the auto allocation of the top 20 mutual funds is at a 4-year high. So then by process of elimination, you move towards pharma. It's not, I don't think it's a very strong bottoms up sector view that is driving more allocation towards that. It's some bounce back which is happening for some of the stocks like Gland, Aurobindo, DVs, which had corrected a whole lot in the last 1.5 years. So after that bump in the earnings in FY21, which was partially also a reflection of what happened during the pandemic, the last 2 years have been very tepid on corporate earnings for pharma.
That's about the pharma space, but Gautam, I understand Motilal recently initiated coverage on Zomato as well. The target is around 70 rupees. Is that a bit conservative? What's the long-term thesis on Zomato?
So, see, we'll know in fullness of time whether it is conservative or aggressive. What we are sensing as far as Zomato is concerned, it's emerged as a duopoly now, which is the third player out of the way. Second, the consumer adaptation to paying delivery charges, which is what is going to drive the P&L for Zomato, is increasingly becoming more and more evident. Third, you're also seeing some element of operating leverage coming into play. So as far as our current estimates are concerned, we are talking about a break-even sometime in FY25. Of course, there is a downside risk also because we've been going through a bit of a rough patch on discretionary consumption, which sort of impacts QSR, overall food delivery space, and a whole host of other discretionary consumer sectors like apparel and paints and all. But to just subsume a broader point into this, we also turned overweight on consumption this time in our model portfolio after a gap of almost a year and a half. Our sense is that as far as staples is concerned, we will see bottoming out of the demand in the next quarter or two. Commodity prices have already corrected, and we have seen a good 2.5 to 3.5 years of a time correction in many of the consumer stocks. So that is what has propelled us to increase our consumption from 14 to 17%, where we have added Indian hotels, we've added weight in ITC further, and weights in Titan, Godrej, Britannia remains intact apart from some of the other discretionary names like Metro and Vedant. But yeah, specific to Zomato, I would think that lot depends on how the path towards profitability shapes up now, because the stock has already seen a good correction in the last 17-18 months. From here on, it will be a function of how sequential revenue moves, new addition of customers, or the metric that you track, monthly transacting customers, and then of course how the operating leverage plays out for their profitability.
Okay, that's the take coming in on Zomato and the likes. Let's just in fact bring up what the stock of Zomato is up to right now, because that's really been holding up pretty smartly. Not the Nifty, but Zomato, 1.5% higher is where we're currently at. 54 thereabouts is where the stock is. Also, addressing the uncertainty around the EOM norms, it's Policy Bazaar, which is actually in focus following the insurance regulators' guidelines on expense of management. There's confusion over, whether direct policies could actually see a pricing downtrend depending on the extent commissions paid to distributors. And this, in fact, could lead to a flare-up in channel conflicts as well. Of course, this brings the likes of Policy Bazaar into focus. But Gautam, you highlighted and touched upon Zomato. What about the other sort of new age tech businesses? And I would include a Nykaa, etc. as well in that, and even a PB FinTech with a lot of H&I interest in there.
Yeah, Aisha. So right now we just started very, you can say cautiously. This is our first coverage on a new age stock. The rest of the names we still don't cover, but a broader issue in most of those names is that specific to say, for example, Nykaa or Zomato, you're in an environment where discretionary consumption is going through a rough patch, which is impacting the top line growth sequentially as well. And second, the profit numbers are still eluding on a sustainable basis for most of these companies. So while stocks have corrected, in terms of the absolute market cap, they are still, quite heavy. And therefore, till the time you don't see a sustenance or visibility of a profitability or a cash flow, I think beyond certain trading bounds, it looks very difficult to build a case of a multi-year return right now, looking at the current estimates of profitability. So one will have to obviously keep a watch on these things because the history of their listing is quite limited. So how those spaces evolve, where things settle down as far as revenue growth is concerned. And some of these companies or brands will also see, I think, an elevated competitive intensity as we move forward. So in that event, how do they react? Because a lot of their growth right now is also coming from recruiting new customers in this new age business models, a new age of getting food delivered, a new style of getting food delivered or cosmetics delivered. Moment you have 2 or 3 more competitors in some of these spaces, how the operating metrics evolve is something which is still unknown. So we will be very, very cautious there and keep looking at numbers before getting more constructive.
When it comes to the new age tech space and making small steps into that space. But before I let you go, Gautam, I think you've increased your weight when it comes to Reliance Industries as well. What kind of upside should one expect there? Is there anything else apart from the usual O2C business that's giving you the confidence?
Yeah, so the call on Reliance was more from a risk-reward perspective after the underperformance of last year and a half. We thought valuations at this point of time look quite reasonable for Reliance, and our own view on the earnings for Reliance the coming year is quite constructive. Second, at some point of time, you will definitely hear some catalyst around potential listing of one of the two businesses. So risk-reward point of view, it did make much more sense at 20 to 50 to increase the allocation. Therefore, now we are almost neutral on Reliance versus a big overweight that we had a couple of quarters back.
On that note, we'll let you go. Appreciate you joining us, Gautam, and talking to us about a whole host of stocks and the sectors as well.